Well, we're delving into whether a portfolio invested in an index of shares will deliver better returns than one in which a professional manager actually selects the shares. And for that, Mike Estment of NFB Financial Services Group joins me now at the desk. Thanks so much for joining us this afternoon, Mike.
Hi, Alicia.
Well, the last time you were here, we had a look at active versus passive management and the pros and cons of both in the current economic environment. Recap very quickly on the onset for us what the choice would be dependent on.
I think the point about active management is if your stock picker, portfolio manager, stockbroker gets the selection correct, then typically our experience in South Africa is that the better guys deliver fantastic results. It's also true, and there's a very strong argument, that the less capable managers have underperformed dramatically, making passives, which are typically less expensive at the factory door, more attractive.
So let's look at this, because one of the sticking points is that trackers tend to be cheap because you don't have to pay for stock selection expertise of a fund manager. A lot of fund managers, when they are performing, are also charging performance fees. So how do trackers actually measure up against managed funds, taking all of these costs into consideration as well?
Well, the top 5 or 6 managers in South Africa, at this point shall remain nameless, but they're out there, and their numbers are up in lights in all the financial media and the newspapers, have net of those performance fees done exceptionally well. The point really is that the active manager in South Africa is able to take bets materially differently to the all-share index, and the all-share index is one of the biggest index or passive tracking type investments. It can't perform if resources aren't doing well, because there's such a big leaning towards the big cap stocks and a couple of resource stocks.
With that, of course, diversification becomes this huge emphasis point. We talk of achieving a balanced mandate, so to speak. Of course, establishing what that would be dependent on the individual investor and their risk profile as such. But let's set up a base case scenario here and what a balanced mandate would look like for that base case.
It's a very good point you make, and that is that if you're in a share portfolio or in a share-oriented unit trust, what the man or person, lady has to do is they've got to buy the best stocks they know are going to deliver results, no matter whether the market's doing well or is expected not to do well. So they remain fully invested in shares, and you run along with whatever the tide of the all-share market does. If you have a managed portfolio, you'd have a balance between equity, typically between 40 and perhaps a high of 75%, depending on the fund manager's conviction to markets performing. And then the balance of the funds between 60% in a bearish environment and probably 30% in a bullish environment would be spread between property, cash and bonds. Giving predictable returns, less volatile returns, but historically not as interesting.
Let's hone in on what kind of returns, actually, because that's the ultimate question from any investor. I mean, what should one expect from a mandate like this as opposed to what one should expect from a more aggressive approach?
An aggressive portfolio historically has delivered probably between 6 and 10% above the consumer price index. That's not on a consistent basis, because the aggressive stuff performs like blazes and then falls off of a precipice and leaves one scared, and probably the greatest danger is the person capitulates when things are at their worst. They've hung on too long and then they get out just when things are about to turn and go better. So typically equities, the JSE over 25 and 30 and decently long periods of time has done returns of probably 20% annual compound. Compare that to cash that has done less than half of that. And you've also got the tax man that's going to come in and ask for his tuppence. Clearly equities have done significantly better. Properties in the last 6 or 7 years have been tremendous investments here, where you've had capital growth and you've had very nice returns from rentals. Cash, on the other hand, has been a rather depressing asset, where interest rates, although you can't lose money, as long as the bank remains solvent, you've had reduced interest rates. They've halved, and the taxman still wants his piece of the action.
Well, interesting that you mentioned as long as the banks remain solvent, because there is, of course, the other option that you highlighted the last time you were here as well, in structured products, where there's the strong reliance on a strong balance sheet moving forward. Let's take a look at that and what that offers the investor and how it works to actually offer the investor some reassurance.
There are countless options in what are called structured products. It's a catch-all type of phrase. But the simplest as we've applied, is that you buy some form of guarantee. So there's kind of a parachute. You can't you can't get below what you put in, or you can't get below what you put in plus a nominal return. And then the product generator creates an option which gets you participation in, for example, the all-share index.
Yeah.
So you'd have your 100 Rand back, you might have a 20 Rand return over 5 years, and you might have 70% or so of an index. Typically, the all-share is a very popular one for us because it's very liquid. What you give up is that 20 or 30%. So you're only getting 70 of the market. The 30 you give up of whatever the market does, you give up because you've got to sleep easy. You've got a capital guarantee and a return of, say, 4 or 5%.
You're giving up that. Are there any risks to this? I mean, surely it doesn't come risk-free.
Yeah, very good question. It's who underwrites that.
Yeah.
So it's almost like taking an insurance policy. It's all very well paying your premiums, but when a claim happens, you want to know that the money's safe. So make darn sure, as an investor, the caveat emptor is to the warning to the investor is, make sure that who you deal with will be there and will be able to meet the promise in 5 years' time.